Realty Income Corporation, stock ticker O, is one of the most popular REITs out there with a high starting dividend yield sitting at about 5.67%. They're actually a dividend aristocrat, meaning they've been increasing dividend payouts for 25 consecutive quarters, and they pay out dividends on a monthly basis, and they actually just released their latest quarter's earnings, which we need to dive into. Now, there's a lot to cover, so let's go ahead and dive in. To start off, we can see Realty Income is down about 5% in the last year, and if we look at them year to date, they've actually done fairly well, currently up about 7%. But what's concerning is when we zoom out and look at that 3 or 5 year chart. Down about 8.98%, while the broader market has seen a huge rally in the last 5 years. And this has been very concerning for a lot of investors. So what's going on here? What's the reason for this? Are the underlying fundamentals of Realty Income weakening? Well, let's take a step back for a moment and talk about the macroeconomic environment that Realty Income is currently operating in, because that definitely plays a role. To start off, let's look at the US 10-year Treasury. What is this telling us? Well, right now, it's sitting at about 4.24%. And look at the trend of it over the last 5 years. There's a direct correlation with what's been going on with the US 10-year Treasury and with what's been going on with Realty Income stock price. What do I mean by this? Well, we need to remember the old Warren Buffett quote: "Interest rates are to asset prices what gravity is to the apple." When there are low interest rates, there is very low gravitational pull on asset prices. What is he talking about here? Well, it comes down to what investing is ultimately all about. It's about risk-reward scenarios. The more risk you take on, the more you expect to be rewarded. So let's pause there for a moment. Why do people buy Realty Income stock? They buy it for the dividend, the high dividend yield that's paid out on a monthly basis and that's been increasing for 25 consecutive years. And right now, that starting dividend yield is about 5.67%. But now when it comes to buying assets, whether you're buying stocks, REITs, or really any other type of investment, what are you doing? You're taking on risk. And at its worst, a business could go to zero. That's the risk you're taking on. So keep that risk to reward scenario in your mind for a moment. Now, when we go back to the US 10-year Treasury, you can get a 4.24% yield taking on 0% risk. This is essentially guaranteed. So with that in mind, how are these two correlated? Well, when these interest rates are increasing, investors that are seeking yield are turning to these high interest rates, even though it's slightly lower than the starting dividend yield for Realty Income, because there's essentially no risk. It's risk-free. A lot of people think that's more attractive from a risk versus reward scenario. And so because of that, Realty Income has not been nearly attractive to investors seeking yield over the last 5 years. But what does this do? It creates forward-looking opportunities, because what's been happening over the last 5 years with Realty Income? While the share price has not gone anywhere, essentially it's actually been going down, they've continued to grow adjusted funds from operation. Now, that's perhaps the most important metric for REITs. It's essentially like earnings per share or free cash flow per share for your typical stock. So if we jump over to TIKR.com, this is a new tool I've been using, we can see the adjusted funds from operations for Realty Income charted out over the last few years and what the projections look like for the next few years. What do you notice? This is a company producing very predictable cash flows. Every single year, like clockwork, it continues to grow. So again, what does that mean? During the midst of when this stock is selling off, adjusted funds from operations has continued to grow year over year. So what does that mean for the valuation? Well, it means the valuation is continually becoming more attractive every single year. Starting off in 2018, we can see adjusted funds from operations at $3.19, while the annual average price was about $57. This would give them a price to AFFO ratio of 17.87. Again, this is like the PE ratio for your typical stock. So this is what they were at, 17.87. The following year, the share price went higher, giving them a higher valuation. We can see year after year, they're sitting in that about 15 to 21 price to AFFO multiple range. But then the sell-off started. The stock continued to sell off, but AFFO per share, the ultimate driver of intrinsic value for REITs, continued to climb higher, and this has put them at their most attractive valuation that we've seen in the last decade. Now, with that being said, it's important we still understand what type of investment Realty Income is. This is not a high-growth investment. Adjusted funds from operation is not growing at double digits every single year. In fact, we can look at the estimates over the next few years. If we scroll down, we can see adjusted funds from operations. It looks like for the most part, they're projecting around 3 to 4% AFFO growth over the next 3, 4, 5 years. And honestly, that's pretty typical for a REIT. And this is important as it relates to the dividend. We'll come back and talk about this here in just a little bit. So fundamentally, Realty Income has continued to go stronger while operating in this higher interest rate environment. environment. And while it does remain to be seen what the Fed will do here in around 40 days, right now the odds are showing about a 93% chance that we do get a rate cut on September 17th. There's plenty of time for that to change, but that is the odds right now. So now we have a little bit of background surrounding Realty Income. Let's talk about that recent earnings report. If we look at what happened, we can see Realty Income Q2 funds from operations of $1.06 basically met expectations, and then revenue of $1.41 billion, which grew about 5.2% year over year and was a beat by $80 million. But here's the good news. They raised the low end of their adjusted funds from operations per share guidance to a range of $4.24 to $4.28 versus the consensus of $4.26. So overall, this was pretty good results, and increasing guidance is typically one of the best things you can see when it comes to an earnings report. If we dig into the earnings report just a little bit more, we can see globally we invested about $1.2 billion at a 7.2% weighted average initial cash yield, equating to a spread of 181 basis points over our short-term weighted average cost of capital. So essentially, this is the spread. This is the profit they're making on a very basic level. The weighted average initial cash yield of their investments is higher than their weighted average cost of capital. This is how REITs make money. And what's interesting about Realty Income is this is such a large REIT, they've really been expanding in Europe. European investments comprised about $889 million, or 76% of the quarter's activity. And if we keep scrolling down, we can see the company ended the quarter with 98.6% portfolio occupancy. That's phenomenal. Realty Income typically is around that 99% range, which is very solid for REITs. A lot of REITs shoot for that 92 to 94% range, but again, Realty Income consistently around 99%, which is one of the reasons they've been so reliable over the decades. Now, while we're on the subject of the investments that Realty Income is making, we do have to point something out, and I always discuss this when looking at real estate investment trusts, because it's a mistake so many people make. If we go ahead and jump over to our stock screener, let's plug in O and hit enter. And all this data will automatically load in thanks to the help of the TIKR data add-on. Like always, if you'd like to be able to download any of these spreadsheets and get access to the TIKR data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, the key thing we want to pay attention to here is shares outstanding. Again, I always point this out, and to most people, this looks like a major red flag. Share dilution is typically not the friend of the investor, but REITs are different. REITs are required by law to pay out 90% of their earnings in the form of a dividend. So essentially, they have two ways to raise capital to continue to grow. One, they can take on debt, or two, they can issue new shares. And it's pretty clear to see what's happening here. When they were operating in a low interest rate environment, they weren't issuing many shares because they were likely taking on debt to grow, but when we're operating in a high interest rate environment, they're issuing far more shares. This is why it's so important to look at these metrics on a per share basis. We don't just look at adjusted funds from operations growth, we have to look at it on a per share basis to account for that share dilution. Now, if we jump over to their investor presentation from the recent quarterly earnings, let's take a look at that 2025 guidance just a little bit more in depth. Now, again, the important one that we already pointed out, going to be the AFFO per share guidance. We can see previously before the recent quarter's earnings, the low end was about $4.22, but now the low end is projected to be at $4.24. That seems minimal, but it's obviously a good sign. Again, we can see occupancy expected to be over 98%, and there wasn't any changes to property expense as a percentage of total revenue. Now, as I was pointing out earlier, Realty Income's occupancy is consistently better than the average S&P 500 REIT, and that's exactly what's charted out right here. The median S&P 500 REIT typically has an occupancy rate of about 94.4%, meanwhile Realty Income about 98.3%. On top of this, Realty Income has perhaps some of the highest credit ratings out of all the REITs, and has paid dividend for 661 months in a row and grown that dividend for 111 consecutive quarters in a row. And then, of course, when it comes to REIT, we have to talk about the debt profile. What we can see is Realty Income has spaced out when their debts are due, which of course reduces the chance that they'll run into trouble refinancing. Now, if we look at the debt profile down here, we can see 95% of their debt is fixed rate, meaning that the interest they pay won't change. And this confuses a lot of people because they wonder, well, why would interest rates being lowered impact Realty Income if they have fixed rate debt? Well, again, it's about valuation. It's about risk-reward scenarios. It's not directly impacting the fundamentals in the debt profile of Realty Income. It's impacting the way that investors view Realty Income from that risk-reward perspective. So overall, the debt profile for Realty Income looks fairly attractive. So with all this being said, is Realty Income interesting at their current prices? Well, let's just go ahead and jump over to the REIT valuation spreadsheet and see what we find. Thanks to ticker data, the data will load in. Now, there's three valuations that we want to run Realty Income through, and the first will be an AFFO multiples valuation. Essentially, what we're doing is looking how the market is valuing REITs that are somewhat similar in structure to Realty Income. Again, there's never any perfect comparable, but what we can see out of these three other REITs, the average price to AFFO multiple is about 15.53. Meanwhile, Realty Income is sitting at about 13.4. So if we applied that same average P to AFFO multiple to Realty Income, the fair value would be about $66.19, which certainly gives it some upside from that current price of $57. Now, if we look at the historical price to AFFO, this is what we've already discussed. What we're doing is essentially looking at how the company has historically been valued. Here's what we're seeing right there. We can see this charted out. What do you notice? That price to AFFO multiple is the lowest it's ever been in the last decade. At the end of 2024 is 14.11, and for the trailing 12 months now even lower at about 13.59. Meanwhile, the average price to AFFO multiple over the last decade is about 17.81. So it's trading at a pretty significant discount compared to how it's historically been valued. And what's interesting, that 17.81 is pretty much in line with what we're seeing from some of Realty Income peers. Definitely something to make note of. Finally, if we run it through the dividend discount model. To start off, we can see the AFFO payout ratio for Realty Income sitting at about 76.1%. That's a healthy payout ratio when it comes to REITs. Again, when it comes to REITs, we don't look at the earnings payout ratio or we don't look at the free cash flow payout ratio. Again, it's about adjusted funds from operations. So what we can see is if we project 3.25% dividend growth for Realty Income moving forward, we come to a fair value of about $62.80, giving it about 10% upside from its current share prices. Now, the question is, can they achieve that 3.25% dividend growth rate? Well, how can we determine this? How can we determine if this is sustainable long term? Again, it's about the AFFO growth in the future. They're already sitting at about 76%. So if adjusted funds from operations can grow at a rate of about 3 to 4% moving forward over the next few years, then a 3.25% dividend growth rate is sustainable. And like we already saw modeled out here on TIKR.com is they are projecting around 3 to 4% AFFO per share growth moving forward. Therefore, that dividend growth should be sustainable without the AFFO payout ratio increasing. So if we jump over to our output tab, we can see two of the valuations we used. We don't have the historical price to AFFO multiple because it doesn't give us a specific price point, but we did find it's quite undervalued compared to how it's historically traded. So if we average these two together though, we come to a fair value of about $64.49. Current price is about $57.09. So with a 10% margin of safety, your acceptable buy price is about $58. With a 20% margin of safety, acceptable buy price about $51.60, which I do want to point out, over the last few years, there have been a few opportunities to buy Realty Income within that 20% margin of safety range. And this is why it's so important to have stocks on your watch list to fundamentally understand those companies so you know when the opportunities present themselves. So go ahead and let me know what you think of Realty Income in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.